Hi everyone, welcome back to my YouTube channel. This is Manisha, and in today's video we are going to solve further quiz question, and this is from the chapter 8 of Hub from financial accounting subject. So previously we have solved up to chapter number 7. So in this video we will solve chapter number 8. So first question is, an item of inventory was purchased as 20. So this is the cost, and the selling price has been fallen to 14, and further cost of 2 will be incurred before sale. So 14 is the selling price and cost 2 is your cost to sell. So deducting this from the selling price will give us NRV, which is a 12. Now the question is, what is the net realizable value of inventory? So selling price minus cost to sell is NRV, and selling price is 14, cost is 2, deducting it will give 12. So our 12 is our answer. It's very easy, na? Okay, next question. After a profit and loss of Santa had been prepared, some inventory was found at the back of the warehouse which had been excluded from the physical count. So inventory value was 100. So how does necessary adjustment affect gross profit and the assets? So to correct this error, we need to consider the inventory of value 100. That means value of inventory will be increased by 100 because it was excluded earlier from the physical count. So it's very much sure that our asset inventory, which is our current asset, will increase because previously we have not included. So option A and B is out, so either C or D could be our answer. Now for the gross profit part, inventory, that means closing inventory, is also the part of the cost of sales. And how we calculate the gross profit? Sales minus cost of sales. But if we talk about the cost of sales formula, what is the formula? Opening inventory plus purchase minus closing inventory. So if closing inventory will increase now, if we will consider this 100, our closing inventory will increase. If it will increase, it will reduce the COS amount, cost of sales. So if it will reduce, our gross profit will again increase. So inventory is an asset, so it is added to the asset, it will also increase, and our gross profit will also increase. See. Now next question. Okay, Spain has incorrectly included closing inventory in its financial statement at 32,943 instead of 37642. What is the result of an error and the necessary correction? So correct value of inventory was 37,642, but they considered 32,943. So what is the difference? Difference is 37642 minus 32943. So sorry, difference is 4699. So that means inventory has been recorded lessly, so understated previously, right? So what do you think, our profit is understated or overstated? So as I said, inventory is a part of cost of sales, so it has been shown less. That means our cost of sales has been increased, which has led to decrease in the profit. Okay, so I'm again repeating, inventory is a part of the cost of sales. Why? Because we deduct closing inventory. So if we have shown closing inventory less, that means our cost of sale is more. If cost of sales is more, that means gross profit is less, and if gross profit is less, then our profit is also less shown. That means understated. So that means our option B and C is out. Option B and C is out because inventory is understated. Now how do we correct this? Obviously we need to increase the inventory value by increasing the debit and credit the cost of sales by 4669. Okay, all right, because inventory is the asset, we need to increase it, so it should be on the debit part. Now next, At the end of the accounting period, a business erroneously excluded goods from on the a business erroneously excluded goods bought on the credit from its closing inventory. It also failed to record the purchase on those goods in the accounting record. The effect of this omission is to understate which of the following. So, question is asking regarding the understate, right? So, which balance has been understate? So, obviously, this transaction has been omitted. That means inventory has been not be booked. So, current inventory is a part of current assets. So, current asset has been reduced. Understated. So current asset is for sure. So option B is out. Then next we have a credit. So the goods was bought on the credit. So we must have to hit the trade payables, but we didn't. So trade payable is a part of the current liability. So current liability is also understated. Okay, so finally we move to the last question. And the question says, which of the following statement about inventory record for the financial accounting purpose are correct? So first one say, when continuous inventory records are kept, there is no need to count physical quantity. No, we need to count the physical quantity. Okay, so we need to count it. Even if business keep continuous record, it still must do physical count to check for an error, or to confirm the accuracy, or to confirm whether the inventory has been theft or not. Yeah, so option 1 is incorrect. So that means A and C is out. When physical quantity are recorded at the period end, there is no need to maintain continuous record. Yes, this one is the correct. So if we are maintaining the physical record quantity, so there is no need to maintain continuous record. Yes, we did it. So in next video we will go for chapter 9. So stay tuned with my video.